At its core, stock investing is a bet on the future. If you're optimistic about the economy and the business in general, well, you should invest in stocks. So if stock investing is a bet on the future, wouldn't it make more sense to hunt for companies that play on the future itself? Well, such companies have been given the name of new age companies. And today, we will talk about how you can pick the most promising ones for your portfolio. Hello and welcome to ET Money's YouTube channel. Now this video is part of our series on how you can go about picking stocks. We have a complete playlist of such videos, so do check them out after you watch this video. Now before I start, here is another important update. We've recently launched the stock discovery feature on the ET Money app. With just one tap, you can now get every detail about a stock and its underlying business, plus a lot more. So do check it out. Alright, so let's begin with first understanding what new age companies are. So if you want to invest in new age stocks, the first thing you need to do is identify them. In other words, what distinguishes a new age company from the traditional ones? Now, some of the characteristics of new age companies include they tend to either operate in the technology sector or leverage technology for their core functions. They focus on innovation, often have high growth rates, and that's what attracts investors to them. Can be disruptors that challenge the mainstream traditional players. Prioritize improving the market share rather than improving the bottom line. They often rely on external funding. They tend to have VCs and PEs as major investors. So, based on these criteria, you can determine whether a stock is a new age company or not. Now, there is no specific index that tracks new age stocks, so there is no ready-made list of such stocks. But a basic Google search throws up quite a few names. Now, this can be a good starting point for research. Of course, this is not an exhaustive list, so feel free to include any companies that are not on the list. Alright, let's now start with a step-by-step framework that you can use to pick promising new age stocks. But before I start, here is a quick reminder. Neither this framework nor the stocks discussed are our recommendations. We don't intend to tell you the so-called hot new age stocks. Instead, we intend to tell you what it takes to pick stocks in this space so that you can do your own research. So let's begin. New age stocks are characterized by the new way of doing business. So the very first step while evaluating them should be studying the business model. And when you do so, you should assess the uniqueness of the business model, the entry barriers, the competition, the business moat, and so on. In other words, perform a SWOT analysis of strengths, weaknesses, opportunities, and threats. Now, to be fair, no business model is flawless. So as an investor in new age stocks, your challenge is to judge whether the company stands in aggregate. For instance, consider Zomato. We recently analyzed it in a video. Now we know Zomato as a food delivery platform, but in reality it has four businesses: food delivery, quick commerce, going out, and B2B supplies. All its businesses, especially its quick commerce business under Blinkit, have massive room for growth as well. However, Zomato's businesses have low entry barriers, high competition, and heavy reliance on its restaurant and delivery partners. And these are potential areas of concern. Similarly, consider Ola Electric. We analyzed this company in detail at the time of its IPO. Ola Electric manufactures electric two-wheelers and core EV components. The company is a key beneficiary of the shift to EVs from internal combustion engines. Now, as of FY24, it has cornered a market share of 35% in electric two-wheelers, up from just 6% in FY22. So, Ola Electric is riding high on early mover advantage and sectoral tailwinds. But this focus on grabbing the market share has come at a cost. The company has been making losses and has significantly increased its debt. It also faces ample competition from unlisted electric two-wheeler manufacturers such as Okinawa, Hero Electric, Ampere, and Ather, and from established mainstream two-wheeler makers. Now, these two examples showcase the dilemma you are going to face as a new age stocks investor. There will be growth, but there will be competition too, and this can translate into an uncertain future. Now, this dilemma is inherent to picking stocks in the new age space. So your first challenge is to resolve it. How you will do it will largely depend on your investment mindset, skills, and preferences. Now this brings us to the next step, checking the growth. Growth is a crucial attribute of a new age stock. It is also why you may want to invest in a new age stock. But it's also important to put this growth into perspective. For instance, let's use the available data to check the year-on-year revenue, net profit, and operating margin changes of some of the new age companies. Consider Affle India, a mobile marketing company. Affle's revenue growth has been good year on year, but its margins have contracted sequentially. Here's another example. Nazara Technologies, a gaming and sports media platform. After high double-digit revenue growth in 22-23 and 21-22, the company's revenue grew by just 1% on a trailing 12-month basis between 2023 and 2024. Easy Trip Planners, which runs the Ease My Trip platform, is experiencing a downward trend in revenue growth. In recent periods, its PAT growth has also contracted. The point is simple. When hunting for promising new age stocks, you shouldn't take growth for granted. Rather, dig deeper into the numbers and try to figure out if the key growth matrices are expanding or contracting or are stagnant. Then try to find out the reason for that. Now, it's normal for businesses to go through up and down cycles, but this is more pronounced in the case of new age stocks. So your focus should be on the more structural reasons that can have a lasting impact. For instance, consider One97 Communications or Paytm's revenue growth. From over 50% year on year in 22-23, it has dwindled to about 6% thanks to the RBI's curbs on Paytm Payments Bank. The company has been fighting tooth and nail to emerge from this crisis. Now, some new age companies have been loss-making too at the PAT level. For instance, Delivery and One97 Communications have made losses over the past 4 years. PB Fintech, which operates the Policy Bazaar platform, and Zomato have recently turned profitable. So, if a new age stock is in losses, try to assess what's happening in the business. Are the losses contracting or are they growing? Does the company have a roadmap to profitability? Well, if the company has just reported a profit, try to figure out its durability. Is the profit because of an exceptional gain? A company reporting a profit after a series of losses can also be a turnaround play. A few weeks ago, we published a video on spotting turnaround stocks. I have mentioned its link in the description. You can watch the video after this one. Now, it's also advisable to consider cash flows from operations in conjunction with profits to ensure that the profits are indeed converting into cash. Notably, Brainbees Solutions, which runs the FirstCry platform, has been suffering from negative cash flows. Ditto for Ola Electric and Zaggle Prepaid. PB Fintech or Policy Bazaar has reported positive cash flows lately. Delivery and Ixigo also belong to this club. So does Zomato. Now, a return to positive cash flow is a welcome sign and makes these companies worth considering. Okay, now let's move to the step 3. But before that, let me request you to subscribe to the channel if you aren't already a subscriber. And don't forget to press the bell icon so you never miss a video from us. Checking leverage or debt is crucial while investing in new age stocks, as growth often tends to be fueled by debt. In difficult times, the debt burden can pull down a company's profitability and even result in losses. Prolonged losses can even put a question mark on the company's existence. Now, in a recent video, we analyzed Suzlon Energy and how it had run into crisis due to its massive debt. The company cut its debt, it started to turn around. Now, you can watch this video at the link mentioned in the description. So, let's check the two debt-related metrics for new age companies, debt to equity and the interest coverage ratio. Now, you may be familiar with debt to equity as it's a classical measure. Interest coverage ratio, as its name suggests, helps measure how comfortably a company can service its interest payments. It's derived by dividing earnings before interest and taxation by the interest expenses during a period. The higher this number, the better, but a value less than 1 means the company's interest burden is more than its EBIT. This could be a problem. Now, for the new age companies under consideration, debt to equity levels are generally low, and that's good. Ola Electric is an exception though, with a debt to equity of 1.4 times. Quite a few companies, Brainbees, Delivery, Ola Electric, One97, have a negative interest rate ratio. This is due to their negative EBIT. Office Space, a co-working space provider, has an interest coverage ratio of less than 1, and investors should take note of it. Now, a related metric to check is the cash on the balance sheet. Surplus cash on the balance sheet can help meet debt obligations and mitigate other financial crises. This cash can be compared with interest payments to understand how good a cushion it can be. Now, most companies are in a comfortable position as far as this metric is concerned. Their cash and current investments are more than the interest outgo. But Office Space, about which we talked a little while ago, has current investments and cash of 5 crore against the interest outgo of 93 crores. Now, as we saw, its interest coverage ratio is also below 1. So office space may find it difficult to service its interest burden. Of course, this may not automatically mean a default, as a company has many other avenues to tap. Yet, as an investor in new age stocks, you should take note of this. Alright, now let's move to the next step, which is significant shareholders. As a stock investor, it's always good that you check who the major shareholders in a company are. The presence of renowned investors can inspire confidence in the quality of a stock. Now, the data on investors who hold 1% or more of a company's equity is easily available on many financial websites. Among the significant investors, you should pay special attention to mutual fund holdings in a company. Now, that's because fund houses deploy public money and hence have to be far more thorough with their research than any individual investor. They also need to be on their toes to perform, as they would lose the AUM. Then, they also have more research power, tools, and sources at disposal than any individual can seldom avail of. As such, a good stock would likely not escape their attention. Of course, they have their own restrictions too, and just because a stock is not owned or minimally owned by them doesn't automatically mean it is a bad company. Still, in the case of new age stocks, where the business models are new and untested, checking mutual fund holdings can be quite useful. For instance, consider Mart Intermesh, a B2B marketplace. As of June 2024, the top fund houses invested in the company were SBI, UTI, and ICICI Prudential. They each have a stake of over 2%. And if you check Honasa Consumer, the parent of Mamaearth, there is just one fund house with a holding of more than 1%. So Mart should give more comfort to an investor than Honasa Consumer. But again, don't blindly buy a stock just because an institution or a famous investor has bought it as well. You never know when they sell out. So use this metric as an additional criteria and not as a main metric. Now this brings us to the next step, which is valuations. Growth is good, but growth at any price is not. Hence, it's crucial that you check the valuations before investing in a new age stock. Now, there can be many measures of valuations, but for growth stocks, PEG or PE to earnings growth ratio stands out. That's because it helps assess a company's valuation in light of its earnings growth. But feel free to check other valuation measures such as PE or market cap to sales or EV to EBITDA if you want to. Now, the PEG ratio is derived by dividing the price to earnings ratio by the earnings growth rate for a specific period. A PEG of less than 1 indicates a stock at a bargain. Now, the table on your screen shows the PEG of the new age companies that we talked about in this video. We have considered the 5-year earnings growth here. Admittedly, there aren't many companies that are below the PEG of 1, but 4 names stand out: Cartrade, GoDigit, RateGain Travel, and Zagler Prepaid. So, this was a 5-step framework to pick new age stocks. Let's now conclude this video with some pitfalls that you should try to avoid while investing in new age stocks. Just like turnaround stocks, investing in new age stocks has its own risks. New age companies can have unproven or untested business models. Competition tends to be a major challenge from them. Their growth may suddenly stall and the profits may suddenly evaporate. As an investor in new age companies, you should be mentally prepared for such setbacks. To mitigate this risk, stay abreast of the company's performance and industry and business trends. Check the quarterly results and go through the annual reports. Now, it's also good to diversify your portfolio and not take concentrated bets. Don't allocate a major portion of your portfolio to new age stocks. And if you realize that this space is not your cup of tea, feel free to ignore it. There are a lot more stocks in the traditional mainstream space to bet on. And with this, we have come to the end of this video. I hope you found this video useful, and if you did, don't forget to share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.